Hey everyone, welcome back to Corporate Decoder. Today we're diving into PAYCHEX's latest annual report. If numbers could talk, this one would be yelling acquisition. Let's get started. This report is basically PAYCHEX's year in review, telling shareholders how the company performed over the last year. We'll break down the key numbers, what the company is planning, and what risks they see, which basically translates to what keeps management up at night. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below for even deeper discussions. First off, let's talk about the forward-looking statements. Companies always include these so they can't get sued for making estimates. It's basically PAYCHEX saying, hey, we're making predictions, but things might change. They list a bunch of things that could throw them off track, like keeping up with technology, cyber attacks, and government regulations. The big news? They bought Paycor HCM. This is a huge deal, which we will see in the numbers. PAYCHEX is hoping this helps them move up market, which means getting bigger clients and to get fancier with AI in their services. They also mention their strategy, which includes growing their client base, getting clients to use even more of their services, expanding their share of wallet. That's keeping up with tech and making strategic acquisitions. Client retention, how many customers stick around, is a key number for PAYCHEX. The report says it was in the 82 to 83% range, meaning they kept most of their customers. Now for the part everyone cares about, the financials, let's dive into the hard numbers. Buckle up, it's about to get interesting. Okay, total revenue, the money PAYCHEX made hit $5.6 billion. That's a 6% increase. Great. Now, what does that percent mean? A lot of that is due to one thing. The acquisition of Paycor. When we look at their bread and butter, that is the part that not related to Paycor, the management solutions segment revenue only increased by 3%. That's concerning and something to take notice. This means the core business isn't growing as fast without these inorganic moves. It seems like they are having trouble winning contracts unless something is bought. Speaking of PO and insurance solutions revenue, that did a little better and increased by 6%. Again, that's pretty much the normal steady state for these juggernauts. It means they're signing new steady customers at a good clip. Here's something interesting. Remember how interest rates have been crazy over the last year? Even though the average investment balances of their deposits increased and interest income on funds held for clients increased, the interest rate earned actually went down a bit, going from an average of 3.8% to 3.7%. Might not sound like a lot. It really shows you that the interest rate magic they were getting isn't there anymore. Now, expenses is where it gets messy. Total expenses shot up 8% year to year. Again, that's the inorganic numbers causing lots of distortion. Looking carefully, where did the expenses go? Turns out a lot of it is coming straight from the acquisition of Paycor. They have a bunch of one-time transaction expenses, such as $162 million one-time acquisition cost. These one-time expenses can make the business look worse on purpose, since they can take advantage of it for tax expenses. This inflates their expense numbers. They straight up admit integrating these two corporate behemoths isn't going to come without its challenges. That's a huge risk because if the two sides don't work well, then all those purchases won't work out. The report continues to mention a variety of other risks to the company, such as what happens if they don't keep up with tech and AI. They also mention what happens if their clients fail and the debt they made for their clients' payrolls come unpaid. Speaking of debt, they make sure we are aware a downgrade in their credit rating could hurt them. They basically said they want your business, just not during the low points. Finally, they noted the risk of legal action and not handling regulations well. It's the usual don't sue us legal jargon. One point from their risks, which may be the most impactful to the firm, is that if credit becomes more expensive, it will be harder for them to buy other companies. Inorganic growth is where they seem to think opportunity lies. They touch on finding and keeping talented people and not ruining their brand with bad press. It is all of a sudden very human for a financial doc, which is also interesting. And now let's go to a few more financials. Looking at the components of wealth now, it seems everything is pretty standard with little movement except for small value being traded between things like properties, equipment, and software. They're also paying off debt pretty fast. It should be noted they are silent about large changes and disagreements with the accountants. Now, zooming out of all these pages of government mumbo-jumbo, here's my assessment. PAYCHEX faces two key realities. First, PAYCHEX's core business isn't growing nearly as fast. If we take away all the buying they've been doing, are they unable to get new customers without buying? This is a problem because relying on purchases to grow is not sustainable. We call those Ponzi schemes after all. The risk to the financial strategy is very high here. Hadden, on the other hand, its core business still has its reliability to bank on. There isn't a big exodus of employees. It's the key strength. PAYCHEX is a cash generating juggernaut, always printing steady value, always. The biggest risk is they don't integrate their purchase or they buy too much and spread themselves thin. Looking ahead, the most notable opportunity is AI. Can they make things simpler and cheaper through AI, or does AI take away from their services because we start to use less middlemen? Basically, the next few years are going to come down to how successfully they either innovate or buy out the innovation. They need new core organic growth, and soon. Alright, that's our breakdown of PAYCHEX's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description and join our community. Thanks for watching. See you next time.